It's Friday, 17th of January, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, another year of double-digit gains for the S&P 500, plus risks to this stock market bubble. But first, calling in from the Departure Lounge in Changi Airport in Singapore, it's Group Chief Economist Neil Shearing. Hi there, Neil. How was the week, and did you get much chili crab in?
Hi, David. Yeah, good week. Good week speaking to clients. It's been and nice to get out of the chilly UK weather and into some warmth in Singapore.
I can well imagine. It's an interesting place to be, given where we are in the calendar. We're just a few days away from Inauguration Day. That's happening on Monday, midday DC time. I'm very curious to know what the mood is in Asia, given the vulnerability of some of the big economies there to Trump's trade policies.
Well, I think it's fair to say the mood's not very different in Asia, at least as far as I can tell, from what it is in Europe or, for that matter, in the US. We're all in wait-and-see mode, aren't we? We don't quite know what's going to happen on day one. We've, of course, been promised various actions on day one, to what extent is that rhetoric? And of course, the mind goes back to 2017 in Trump's first inauguration. Shortly afterwards, we had that speech about carnage in America that set a very dark tone. And I think people are wondering to what extent that is likely to be repeated. So there's a sense of unease, I think. We're all in wait-and-see mode. I think that's true, as true here in Asia as it is anywhere else in the world. And we'll wait and find out and see what happens in the next week or so.
I mean, is there any more clarity in terms of what we can expect on the policy front? We've been in this fog since early November. We would expect it to start clearing next week, but there have been some noises coming out of Washington in that time as well. So what do we know at this point?
Well, we've had various media reports specifically about tariffs, haven't we? About whether or not we had that Washington Post story about them being potentially used as a negotiating tool. Then, of course, Trump pushed back against that, decried it as fake news on Twitter. And then this week, we've had an idea leaking out that tariffs might not be implemented, at least in full immediately. They might be imposed at 2 or 3% and then ratcheted up slowly, again used as a tool to extract concessions from US trading partners. The other event that we've had this week has been confirmation hearings starting for key cabinet picks. So Marco Rubio, Secretary of State, Scott Bessent for Treasury Secretary. And I think one of the key threads running through both of those confirmation hearings was a pretty hawkish stance against China. So I think one of the things that, yes, there's an enormous amount of uncertainty about the exact nature of policies that the Trump administration might pursue, but I think a thread running through that, a key focus is going to be China and countering China's rise as a strategic rival to the US. It's obviously something we've written a lot about, but I think it's something we can be reasonably confident is coming down the track from this administration.
And I guess, as you alluded there, the key point is you've got people like Bessent, you've got people like Rubio, they have views on policy, but at the end of the day, it comes down to what Trump wants to do.
Yeah.
I think we had a note saying it's Trump's world, his cabinet just live in it.
Yes, I think that's exactly right. I mean, of course, Secretary of State in particular, in the first Trump administration, Rex Tillerson, who was Trump's first Secretary of State, lasted barely just over 2 years. Obviously, Steve Mnuchin, as Treasury Secretary, lasted the full term in office, the full 4 years. So it remains to be seen the extent to which either of Bessent or Rubio, assuming they're confirmed, can deviate from Trump's views on key issues, and the same goes for any other cabinet member for that matter. And it remains to be seen kind of longevity in office as a result of that. So, but I think at this stage, I would characterise most of the hearings, certainly for Bessent and Rubio, as being consistent insofar as they are pushing back against China, and I think that is going to set the tone for what we should expect over the coming 4 years.
Does that tariff proposal, you mentioned that Bloomberg story talking about the sort of gradual increase in tariff over the months. Does that change the narrative in terms of the impact of tariffs, the inflation impacts of tariffs?
Well, in a mechanical sense, if it's a smaller increase spread over a longer period, then mechanically the impact on inflation is smaller but lasts for longer. I think, though, that perhaps the most significant aspect of this would be it would change the intended purpose of tariffs. So rather than tariffs being a kind of permanent source of additional revenue that could be used to, for example, cut taxes elsewhere, if you're imposing tariffs at a low level and then threatening to ratchet them up, subject to extracting concessions from trade partners, you're showing your hand, really. You're saying that this is a negotiating tool. This is a tool to extract concessions. It's not a permanent source, or not intended as a permanent source of revenue, potentially. So I think more than the impact of the tariffs themselves, it's what it's saying about the purpose of the tariffs. And if they start at a low level and are ratcheted up, then it's more likely to be a negotiating tool, I think, than a potentially a permanent source of revenue.
And I guess we'll start getting clarity on all of that next week. And I presume that from Beijing's perspective, a sort of gradual increase would be preferable to the 60% tariff that Trump's been talking about. But in terms of the Chinese economy, which is what I'd like to get onto, because we've just had GDP data out earlier today, I'd be interested to know the kind of discussions you've been having in the region, how we think Trump's arrival is being viewed from Beijing's perspective, but also sort of what the macro story is in China, because obviously if he does carry out his tariff threats, then that's subject to a degree of change, isn't it?
It is. And I think one of the more striking aspects of the data that we've had over the past week or so, including the data today and GDP data, is there appears to be a growing divergence between some of the official data, particularly GDP, and the data that we track, particularly our China Activity Proxy, that we believe gives us a kind of another read, perhaps a potentially more accurate read of activity in the real economy. So if you look at the official GDP data, it's saying that in Q4, growth picked up to just above 5% year on year in the final quarter of 2024, whereas our latest reading for the China Activity Proxy, which is for November, puts economic activity growing at the kind of mid-threes year on year. So potentially a growing divergence between the official data and the low-level data that we're tracking on the ground. And which at this stage is suggesting that the Chinese economy is still struggling. Now, that's not to say that at some point fiscal support and monetary support won't help to drive a pickup in activity. Indeed, that's what we're forecasting will happen in the first and second quarters of this year as fiscal support and monetary support kicks in. But at this stage, the data that we're following doesn't really show a great deal of evidence that that's happening, certainly not to the extent that the GDP data suggested this week.
The other thing I wanted to ask about, because the week began with these comments from Keir Starmer in the UK talking about artificial intelligence. We've got John Higgins, our Chief Markets Economist. He's coming up in a bit to talk about what AI means for the stock market. Starmer was talking about AI as a quote-unquote ultimate force for change and national renewal for the UK. As you can imagine, it's been greeted with the usual skepticism in the press, certainly about the UK's role in this AI revolution. And I guess in some regards, that is just the nature of the British press for you. And I guess if you're standing on a cold, rainy train platform in January, wondering why your train's just been cancelled, the idea that the UK can take some leading role in the AI revolution sounds a bit outlandish. But there is something in that, isn't there? Talk a bit about AI's potential, but particularly talk about the UK and what Starmer's on about.
Well, about 18 months ago, we conducted a major piece of research looking at the economic and market impact of AI, artificial intelligence. And we concluded as part of that research that AI could be regarded as what economists call a general purpose technology. Now, that's slightly arcane terminology, but what that really means is that it's a technology that has a wide range of different applications beyond just the sector in which it's developed. And these technologies tend to be transformative in terms of their impact on productivity and economic growth. So think electricity, steam, the internet, these are all general purpose technologies, and they've all transformed our lives and indeed economic growth and prosperity. So I think AI falls into that category, and we concluded on the back of this work that there would be a pickup in productivity growth, particularly in advanced economies, but that it would probably take until the latter half of this decade and the early 2030s for that to come through. Now, how does the UK fit into all of this? One aspect of the work that we conducted was to construct what we called an AI Economic Impact Index. And the idea of this was to rank countries according to the conditions under which AI might take hold. So we looked at things like the role countries were playing developing the technology, how likely they were to be able to adopt the technology, AI technology, and having adopted AI, how flexible the economy was in terms of being able to adapt to the many challenges as well as opportunities that it would pose. And when we crunched the numbers of all of this, we ranked 33 of the major economies across the world according to these various different criteria. We crunched the numbers, produced this ranking. The UK came out at number 3 out of 33 countries. The US far and away number 1, Singapore number 2, UK number 3. And a bit like the kind of UK commentary this week, I looked at this, that can't be right. The UK can't be ranking quite so highly in this index. But then when we went back and looked at why it ranks so highly, it started to make sense. The UK has a relatively large tech sector. It's a tech hub within Europe. It has a large service sector where a lot of AI technology will be first adopted. The labour market is relatively flexible. So a lot of the criteria and conditions to thrive under AI kind of apply to the UK, particularly relative to European peers. So yes, Starmer's claims looked a bit outlandish on the face of it, but I think there's something to this. Now, AI alone does not make an economic strategy, and the UK's problems are manifold. They will require going beyond just adopting AI. But I think that AI does have a role to play in reinvigorating UK economic growth. And I think the UK is perhaps better placed, certainly compared to some of its European peers, in terms of adopting and adapting to the opportunities and challenges presented by AI.
And actually, the most striking number for me on that AI economic impact index is number 18. That's where China sits relative to the US, as you say, number 1, Singapore number 2, UK number 3. And China's position, I think that does kind of speak as well to some of the problems we've been talking about around its economic model, but also in terms of this framework for thinking about how the global economy is fracturing. Talk a little bit about that.
Yeah, certainly. So, part of the reason why China ranks kind of in the middle of the pack is because its economy is, there are constraints on its ability to adopt AI and then to adapt to some of the challenges that AI will pose. But as you say, global economic fracturing, that is to say, the splintering of the relationship between the US and its allies and China will play a role in this too. And that's because a lot of the technology that underpins AI, some of that comes from China, is being developed in China, but a lot of it, think about the huge need for semiconductors and where that technology comes from, it's being produced not necessarily in the US, but by US allies. And increasingly, it's the focus of export controls imposed by the US and adopted by US allies on China. So AI is a good example of one of those issues where it's a huge economic issue in and of itself, but it cuts across many different areas. And one of those is the fracturing of this relationship between the US and China.
Neil Shearing calling in from a departure lounge in Singapore. Excuse the occasionally shaky sound quality. I'll add our latest read of the Capital Economics AI Economic Impact Index to the show notes, along with the China Activity Proxy, the latest read of that, which Neil also mentioned. These are just some of the prop data tools that clients get for a different and clearer perspective on what's happening in the global economy. On the inauguration, we've got a whole page dedicated to the key US and global policy questions around Trump's return to the White House, which I'll add to the notes. On Tuesday, our US team is holding a drop-in. That's one of our short-form online briefings, all about what we learned from Inauguration Day. I'll add registration details to the podcast notes. And then on Wednesday, our LATAM team is doing a session on what Trump's return means for Mexico. There are also drop-ins this coming week on commercial real estate in the US and UK, and a post-BOJ session on Friday. We're forecasting another rate hike, but whatever happens, our Japan and markets teams will be taking your questions on the policy outlook and the financial markets impact. Details of all of these sessions can be found on our events page, where you can also watch recordings of past events. Events page is capitaleconomics.com/events. Now, brag alert, LSEG Data and Analytics has just named Capital Economics the most accurate forecaster of global stock indices for 2024, meaning CE has won the award for a second straight year after getting named number 1 in the inaugural LSEG Awards in 2023. These wins in part reflect our forecast for the S&P 500, which ended last year pretty much at our target of 6,000. Our S&P forecasts are rooted in the work that Neil referenced on the impact of AI. They were very non-consensus and very bullish when we published them back in mid-2023, but the market has since been catching up with our views on how this technology could drive earnings and how much investors are willing to pay for those earnings. And as Chief Markets Economist John Higgins explained to me when I asked him earlier, 2025 is looking like another year of strong gains for the S&P.
Well, that's certainly our forecast, David. We're anticipating another strong year for the markets. As you know, we adopted a pretty bullish forecast for the S&P 500 back in the middle of 2023, when we felt that artificial intelligence was going to become this transformative technology, the benefits of which would, crystallize pretty quickly in stock prices, even if they took quite a long time to feed through to the real economy. And that underpinned that view that the stock market was going to do very well. And then in the middle of last year, actually, we revised up our forecasts for the S&P 500 even more and adopted a view that it would end 2024 actually at 6,000, which is very close to where it did end that year. At the same time, we pushed up a little bit our forecast for this year and adopted a sort of N25 projection of 7,000, which is obviously about 1,000 points or so higher than we are now. So we are anticipating another strong year and expect that to be sort of driven by a combination of further increase in the stock market's valuation as enthusiasm around this transformative technology continues to grow, and some increase, albeit not as rapid, in expectations for earnings themselves.
You've got this new analysis out, sort of mapping out your thoughts on how the market will develop in 2025. And one thing I think is striking about it is that the report runs through or devotes quite a bit of time, doesn't it, to talking about the risks to the stock market bubble. And you have been calling it a bubble for a while. I'd just like to highlight a couple of those risks and get you to talk a bit about them. One of them is the risk from the bond market, from rising bond yields. We've just had this mini sell-off over the past few weeks. It has unwound a bit, but stocks did react as yields rose, as treasury yields rose. Given the fiscal risks that the macro teams have been talking about heading into 2025, how much of a risk do you think that is to this narrative of another bullish year for the S&P 500?
Not a big one, I think, is the answer to that. I think there's no denying the market did balk at the recent rise that we saw in treasury yields. Clearly see that when you look at sort of the interaction between rising treasury yields and falling stock prices before December's CPI release. But I think if you took a step back and actually looked at the sort of interaction between the performance of the stock market and the treasury market since, let's say the start of 2023, what you'd find actually is that the relationship between the bond market and stock market broke down quite a lot actually over that period. So if you think about, what's actually happened during this sort of 2-year window of very strong growth in the stock market is that bond yields have gone up, right? And yet the stock market has done very well. So I wouldn't put too much emphasis on rising treasury yields as a sort of major downside risk for the stock market. I think even if we were to see a rebound in treasury yields, and I'll come on to why we think that's rather unlikely in a minute, but even if we were to see that happen, I'm not convinced actually it would upend the stock market. And that's because we are anticipating the equity risk premium itself to continue to fall and probably more than offset any increase that you might see conceivably in risk-free bond yields. Obviously, that all sort of feeds into the stock market's valuation more generally. But I think the point I'm trying to make here is that the valuation of the stock market isn't determined exclusively by what happens to treasury yields. It's also determined by the sort of additional compensation that investors require for owning equities. That's to say the equity risk premium. And that has clearly fallen quite a long way already. But we think there's scope for it to continue to fall through the course of 2025 because it remains quite a bit bigger than it was before the dot-com bubble burst. And, we've made a lot of sort of the analogy between what's been going on recently around this transformative technology of AI and what we saw during the dot-com bubble when there was enthusiasm over the internet. So, as I said, it's not that there's no risk from rising treasury yields, but I think, the pudding is often over-egged there. And in any case, we're not actually expecting treasury yields to go up from here for a couple of reasons. First of all, we think that monetary policy will evolve broadly in the way that's now discounted in the markets. And the second point is that we're not anticipating, as some seem to be, a major deficit-financed fiscal expansion from the incoming Trump administration. And if we're right about that, then I think there's less likely to be a risk of the bond vigilantes striking.
What about on the earnings side then as a downside risk? Because again, your report, it talks about how this AI arms race has been driving earnings. How, as you say, a lot of the story is about this transformative technology. And some companies in the S&P have benefited enormously from that. And actually, the earnings rounds last year were quite striking, weren't they? And the number of times you'd hear the big tech firms say that the constraint for them was not the demand side, it was the ability to supply the hardware and the services around AI because the architecture isn't fully developed. But how long can that story run? How much of a risk do you think that sort of those chickens come home to roost in 25?
Well, I think there is a risk, and clearly it's the first one that I think I identified in the piece. If you believe in the narrative that the stock market strength has primarily resulted from enthusiasm around this transformative technology, I think it stands to reason that perhaps the biggest risk to that view is that demand for this transformative technology falters. Right. The problem is it's hard to see evidence of it faltering. It might falter at some point in the future, but, and of course, a lot of people sort of point to the extraordinary growth in earnings that we've seen in some of these technology sectors, as evidence that, it's sort of simply unsustainable. The problem is that it's not clear that those expectations are failing to be met, right? If anything, those expectations generally keep being beaten. And it seems pretty difficult to us to find evidence, as I say, of demand for AI faltering at this stage. So I think it's definitely a risk. I think you just alluded there also to the risk around the supply, if you like, of AI faltering, which of course could also affect the earnings of companies involved in this space, even if the demand for AI remained very strong. And there are clearly, risks around that, shall we say, in terms of potentially the incoming US administration's attitude towards controlling the spread of AI, and also, of course, just geopolitical tensions more generally. But I think if we sort of abstract from those risks, the overall picture that we see is one in which demand for AI at this stage, at least, is continuing to grow at a rapid rate and not obviously slowing. So I think that's what I would say about that risk. I think there is a point more generally to be made, though, about the underlying economic picture. Because clearly, even if the demand for AI remained robust, if the economy more generally were to falter, then that would most certainly be pretty bad news for earnings in general, and perhaps even in the big tech sectors themselves. So I think we need to be aware of that risk. But again, it's not something we're anticipating. We do think Trump's agenda is probably a net negative for economic growth on balance, but we don't envisage the US economy going into a recession. And while we do think, for example, that the dollar's likely to stay strong, and that's potentially going to undermine some of the earnings from US multinationals, foreign subsidiaries, and from US exports more generally, we don't really see that as sufficient to deliver a meaningful decline or drag, shall I say, on earnings growth. So I think the big picture here is we've got earnings going up. That's our view for the S&P 500. Growth and forward 12-month earnings of 3% or so this year. That's nothing spectacular. It's about a quarter of what we saw in 2024 and about half what you've seen over the last 4 decades. But it's growth nonetheless, and we do think it's a factor.
Just to interject there, but another identifiable risk is that our earnings expectations are too conservative. And actually, on that note, the forecast for 2025 is based on this idea that valuations are going to get up to dot-com levels, and that'll basically be the peak. I think it's 25 times earnings. And also that valuation metric proves too conservative because of the AI narrative, because this is a transformative technology that we see. So we've spoken about the downside risk, but are there tangible upside risks here as well?
Yep, I would say there are. And I think those upside risks relate both to the earnings outlook and to the valuation point that you've just made. And, let's not forget that bubbles, now there's a big question mark over whether there is actually a bubble. I know we've called it a bubble at some various points along the way, but the whole sort of question of whether there's a bubble is a bit moot, really, insofar as a lot of the stock market's rally up until this point has been driven by earnings. And, therefore that's something fundamental in nature, really, rather than what you might describe as speculative, which is the price that people are sort of willing to pay for them, if you like, reflected in the valuation. I'm not convinced that means you can't have a bubble in earnings themselves. But as I said, there's a lot of discussion around that. But coming back to the upside risks, as I just mentioned, we're forecasting just 3% or so growth in S&P 500 earnings per share. That's very conservative for this year compared to what we saw last year and on average in the past. And I could conceivably imagine a world in which earnings growth was much more rapid than that this year. The reason we upgraded our forecast for the S&P 500 in the middle of last year was clear evidence that earnings were growing even more rapidly than we'd assumed that they would. Yeah, that's why we pushed those numbers up, not because we actually changed our assumption about where the valuation of the stock market would get to. It was a sort of recognition, if you like, that earnings were growing rapidly and this would continue. So I see that as a possibility, and I think it could come through two channels. One, continued strong growth in the big tech sectors, which after all have driven much of the growth in earnings, or most of the growth in earnings, arguably up until this point. Given what I said about a lack of evidence for demand for AI faltering, I think that's a possibility. And then there's the point that the rest of the market could conceivably see stronger growth in earnings per share. It did start to pick up a growth in earnings per share last year, but not much. And if we do get a pretty decent economy this year, that could also be a contributory factor. So yeah, upside risks on the earnings front. And then just coming to the valuation front, we chose this earnings multiple to which you referred, I think, dot-com levels of 25, somewhat arbitrarily when we initially adopted this bullish view about the prospects for the stock market. And where do we pluck that number from, if you like? Well, it was because that's the peak that we reached during the dot-com bubble, which was the last time we saw some enthusiasm over a transformative technology. Could we go even higher than that this time around? Of course, it's possible. It might not, but it's clearly possible. One reason it could happen, actually, is because, the valuation of government bonds generally is much higher now than it was a quarter of a century ago. And what I mean by that is, you can't really think of the valuation of the stock market in isolation, or at least I don't think you should. I think you need to think of the valuation of the stock market in comparative terms. What is the sort of valuation of the stock market compared to the valuation of the bond market? And we know that bond yields generally now, or government bond yields generally now, are lower than they were 25 years ago. And if you look at these sorts of comparisons and compare the valuation of the stock market with the bond market, it's perfectly possible that the valuation of the stock market could itself go much higher, simply because the level of bond yields now is lower than it was a quarter of a century ago. So I think there is another upside risk there.
I was going to ask how all of this ends. How do we've spoken about another year of double-digit gains. If something can't continue forever, then it won't. So what does the end game look like? John, do you want to go into that?
Well, in terms of when the party will end, David, I think, we set our stall out a long time ago now and made the argument that we'd see a very strong performance in the stock market last year, which we did, that we'll see a very strong performance in the stock market this year, which is a view to which we're sticking. But then there will be a sizable correction in 2026. And for now, we're going to continue to adopt that position. Why did we have it in the first place? Well, clearly, at some point, things are likely to correct. It could correct as a consequence of a bubble bursting. I mentioned earlier on this call that there's an argument that we aren't actually really in a bubble. And the reason for that is that most of the gain so far has actually been in earnings rather than in the valuation. And therefore, how can it be a bubble if it's something fundamental in earnings? I'm not sure I fully accept that argument, because it is possible that we could actually be just having a bubble in the earnings themselves, particularly if the demand for AI turns out to be weaker than envisaged. But as I said, our view that the stock market would come unstuck in 2026 was simply tied to the idea that by the time the end of this year rolled around, its valuation would have got to the level that we saw, at least in absolute terms, not relative to bonds, in absolute terms that we saw at the peak of the dot-com bubble, just before it burst. And therefore, it was likely at that point that we would see some correction after a very prolonged and big rally. Whether that was a bursting of a bubble or just a sort of significant correction that wouldn't last, we can debate that till the cows come home. But that was the view, and it's the one, for now at least, to which we are sticking.
John Higgins on our forecast for another good year for US equities, but also the potential risks to that call. I'll post his outlook for the stock market in the show notes and a page listing all of our recent forecast awards, including that latest one from LSEG. But that's it for this week. Neil will be back next week to discuss what we learned from Inauguration Day and the opening moments of Trump's second term. How's he going to top his American Carnage address? Will we have any more details on tariffs? Will Greenland be American territory by the time we record? We will have answers to all of these questions and more. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.